Hey, all, just a quick update. This is Mitch with Be the Boss of Your Money. It's just a quick late edition, give you a quick update. Stocks steadied today. Yesterday was the year's worst day of the year so far for the stock market. Stocks got pounded on worries that not so much that inflation keeps going up, but more worries on the Federal Reserve Chairman's dogged determination to do anything to get inflation under control. So we're going to talk a little bit about that. I want to take a look at one big ETF, the Vanguard BND, their big total bond market index fund. Excuse me. And we'll take a look at that. We'll take a look at some of the stocks, and I want to take a look at the inverted yield curve. Just give you an idea of what happened today, what's going on, and we're going to make this a very quick show. So stick around for a couple of minutes, and we'll be off. But I think this will be some pretty good value here for you, and I think anything we could do to help you get a better understanding of what's happening with the markets will help you stick to your financial plan, your investment plan better. Because what good is a financial plan if you can't stick with it? So here we go. Thank you for joining me. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. While you're watching, if you don't mind, give us a thumbs up or a heart or a wow or whatever reaction is available to you, depending on which social media platform you're watching on. We live stream to YouTube, LinkedIn, Facebook, and Twitter. Instagram, I post all of my social media channels. I post quick snippets from the day before, from the previous days. Live stream, just to make a quick important point. So if you like getting your content in quick 30-second to 1 minute videos, snackable content, but really good content, really fast, definitely follow me on social, any of the platforms that you like, and you'll catch those. But I would say Instagram is probably the easiest because it's just so easy to look up people's content over there. So at InstaMitchG is my Instagram handle. Go check it out. And I hope to see my follower count go up after today, because you guys all went over there to check it out. If you have a question about what we're talking about today or anything about personal finance or investing, let me know. Hit me up in the comments. I love hearing from you. It's the best part about what we do. And follow me on LinkedIn, Facebook, Twitter, Instagram. Subscribe to my YouTube channel if that's what you're watching from, and I really appreciate it. I see a few of you out there, so say hello. Let me know where you're watching from, and I would always appreciate that. I love hearing from you. It's, like I said, it's the best part of what we do. So let's take a quick look at the stock market today. I'll get rid of the social media icons. We'll take it over here. All right. The Dow is only down 58 points. I say only because yesterday was down 575 points. NASDAQ had a halfway decent day, up 45 points. S&P up 5 points. Very flat day. Gold continues to go down. Oil continues to move lower. 10-year yield up a little bit. Remarkably, the 10-year yield, okay, still below 4%. It touched 4% last week, but despite the entire yield curve up to 20-some-odd years is above 4%, a good chunk of it above 5%, it is very odd to see the 10-year stuck in the fours. It's like, who is buying all these 10-year treasuries to keep it from going higher? The VIX was down a little bit. The VIX has been hanging in like a champ. I always say under 20, things are pretty calm. And with yesterday's drubbing in the market, VIX still didn't get over 20. I mean, it's really holding up very well. It means that the sell-off yesterday was not really like a sense of panic. It was just more of a sense of repositioning, where the Fed pause and pivot that's just going to be delayed. It's going to be later in the year. That's what that means. It means the terminal rate, meaning the final rate where the Fed stops raising interest rates, will probably be more like 5.5% to 6%. Give or take a little bit. It's impossible to know right now. Not even the Fed knows, because you're not on a predetermined course. They're going by the data as it comes in. And here's what I mean with the bond markets. Yields are up. Okay, even the 1 month is almost 4.7%. But from the 3 month, 4, 6, 1 year, and 2 year, you're at 5% plus, okay? But the 10-year is still 3.99%. What does that mean? Well, we do have an inverted yield curve. So let me show you that, okay? You see this over here, 10-year, 2-year, okay? 10Ys, see 10-year, T2Y, 2-year. Yes is for spread. And this is how we measure the yield curve, if it's inverted or not. When it's negative 1.08, this is the widest, this is the biggest yield curve dispersion we've ever had. So the yield curve is just shouting recession, but there are still those who say we can skirt by, not have a recession for reasons that inflation is higher. And, you know, I don't know. It's a bunch of gobbledygook if you really want to know how I feel about it. I can give you 10 reasons of why we're not going to have a recession. I can give you 10 reasons of why we're going to have a recession. We might get a soft landing. We might get a hard landing. We might get no landing. It's all over the place. A few weeks ago, the Fed chairman said, Chairman Powell, he said that he's seeing signs of disinflation. He said, disinflation has begun. Those are the words. Disinflation has begun. And a week later, oh, no. There's a lot of inflation. So, you know, the Fed really should just do less talking and just all action, because Chairman Powell, I think he wants to be a good guy and not disappoint people, but it really is just too bad. The numbers, the stats that come out are the stats that come out, and inflation remains with us. Today was the second day of the Federal Reserve Chairman's deliberations or talks or testimony, however you want to describe it, in front of Congress. Today he spoke in front of the House. Yesterday was the Senate, basically reiterating his call yesterday, his message that interest rates should stay higher. The terminal rate, the point at which we stop raising rates, will probably be a good deal higher than what you're all were thinking, which was 5.25. Now it's like 5.5 to 6. And he's going to keep pressing yields higher, pushing yields higher, because he needs to see the economy slow down. He needs to see a break in the labor market. He doesn't want to see it break. He just needs a break in the stats. So Friday is our next big, that's a huge economic statistic. That's the non-farm payroll figures. We get this every month. Last month was up 517. This month we're expecting about 225 to 250,000 new jobs created. We want to look at the wages. We want to look at how many how many hours per week people worked. These are all the things that give us an indication of how strong the labor market is. So we'll find that out. A strong labor market tells you that Powell is going with a 0.5 point increase, not next week, but the following week. If it's a weaker report, maybe he'll only go with a 0.25 point hike, but he definitely is going with a rate hike. So it's either a 1/4 or a 0.5 point. I would be surprised if he did 3/4. It's just not telegraphed into the thinking right now. And he knows that. It's about a 70% chance, according to the CME, that the CME group, that there's a 50 basis point hike, or 0.5%, and 30% chance of a 25% or a 0.25 rate hike. So that's what I want to show you there. I also want to show you this real quick. This is the I use this as a gauge for the bond market, the Vanguard Total Bond Market Index Fund ETF. And this is down for the year. I just want to show you this, okay? It's down fractionally for the year, but stocks are doing better. And that's the S&P and the NASDAQ are. So we are continuing to see bond market weakness spread into 2023. It's still kind of a knock off of the it's kind of a knock against the 60-40 portfolio. So not much has changed heading into 2023. It's different when the Fed raises rates. It's different when we have inflation. These are scenarios that most of us are not used to. Certainly not in recent history. So that's what's happening. We are getting used to an environment of inflation. There are a number of soothsayers, stock market strategists, who keep coming out and saying, we're going to skate by this. We're going to be okay. We're set up for a big rally. And there were a number that are saying we're not set up for a rally. Things are going to get worse. The market's got about another 20% downside in it. The forecasts are all over the road. And if you want CNBC right now to print your idea, your thoughts, you really have to be very extreme in your calls. You can't just say, no, I think things are pretty good the way they are. We'll probably stay around these levels for a while. Nobody wants to hear that. It's just not going to, it's not going to grab a, it's not going to be a catchy headline, but we don't know. And how about this for honesty? We don't know what the market's going to do next month. We don't know yet what the labor figure is going to be on Friday, the inflation figures Tuesday of next week, or the Fed's decision on interest rates in 2 weeks from today. I wish we did know, but we don't. And part of the fun, believe it or not, is not knowing. We get to enjoy the ride. We get to talk about this. It's interesting. But ultimately, you're not changing your portfolio based on all this stuff, right? You're still investing for the long term. You're dollar cost averaging. You're buying your stocks or your exchange traded funds, what have you. None of this should be changing how you see yourself and what your goals should be and how you're going to get there, 15, 20 years out. This is a lot of short-term thinking, but when you know about what's happening in the market, you're less likely to sell out and panic and more likely to hold on through a difficult time. I know what you're thinking. Well, why hold on to the market? Why hold on to stocks if the market's going to go down? It might come right back up. It might go down for longer. But I know this, if you get out now, you're not getting back in anytime soon. Could be a good thing, but probably not, because when the market goes up, you'll be like, I could have had stocks when they're lower. I'm going to wait. Then the market goes lower, and you say, I'm going to wait for stocks to go lower, and you wait. And then the market goes back up, and you go, I could have bought lower. It just becomes endless procrastination. But we know that time in the market is more important than timing the market. Think about that. Time in the market, more important than timing the market. So these are the things that I wanted to go over with you. Tomorrow, not a whole heck of a lot going on. We'll get first-time jobless claims tomorrow. We'll see what those look like. But everybody's going to hold their breath now until Friday. Another reason why the market held up okay today is because Fed Chairman Powell, Federal Reserve Chairman Jerome Powell, he didn't add anything to yesterday's report to the Senate. So, he didn't add anything new for another reason to sell off. So that's pretty much where stocks were a lot steadier today than they were yesterday. All right, that's my story. I'm sticking to it. I'll be back tomorrow. Tomorrow morning, I have an interview with Stu Ulmer. He is the executive director of Fountain Gate Gardens. That's the new it's a life plan community put up by Gerwin Jewish Health. And it's the first of its kind, as far as I know, on Long Island. So it's going to be an exciting interview. And we're talking about the Bristol and assisted living and nursing home and Medicare and Social Security. This is another solution to people's dilemma of what do they do? Where do they live? How are they taken care of when they're older? And for a lot of us, what are we going to do with our parents? So it'll be on the radio tomorrow, 103.9 FM, LI News Radio. You can listen on the LI News Radio app. And of course, once the show is done, I'll turn the MP3 into an MP4. I know how to do that. And then I'll post it over the next day or so on social media. But it'll be a great show, and hopefully you could tune in. I'll speak with you tomorrow. Thanks so much for joining me.